You're about to watch a fascinating interview with a hedge fund trader who gives us some incredible insights into their opinion of not just Warren Buffett, but also Cathie Wood, what's going on with the banking crisis, recession, and much more. Keep in mind, all of my videos are brought to you by my own programs on helping you build your wealth, whether it's 0 to millionaire real estate investing, do-it-yourself property management, getting into your first rental property, stocks, psychology of money, or learning about LLCs, insurances, and otherwise so you can make more money either with your side hustle, your entrepreneur hustle, or as an employee. Check out all those programs linked down below. That is the primary sponsor, and it is what keeps us going on this channel to bring this value to you. So check that out, link down below. That does it for sponsors in this. Now, let's get into the interview. Hey everyone, welcome back to another episode of the Meet Kevin Show. Today, we are with Bob Kendall of the Kendall Report. Welcome aboard. Thank you so much for being here.
Thank you.
Tell us about yourself. What do you do? Who are you? And let us know. And how can people follow you?
Great. I'll try not to get too involved. I have a lot of different hats I wear. So I'm a software developer. I'm a former trader on Pacific Stock Exchange, also the Chicago Board of Trade. I also have been the head financial analyst for a major firm. I worked Merrill Lynch at research for a while, managed money at lots of big places, consulted about 36 banks, of the largest banks. Actually, I can remember 3 of them aren't in business anymore. Bear Stearns, Credit Suisse, and I forgot the other one right now. So anyway, but yeah, so done a lot of those kind of things been in the markets. I started in Chicago Board of Trade in 1979. Lost all my money. Should I tell that story?
Absolutely, yeah. It was the year Volcker was nominated.
Yeah. I got stuck limit down in 4 days, and when I woke up, they didn't have it. All the money was gone. So it was a good experience, though, because it made me focus on 2 things: the emotions of the event, as well as the, I guess, understanding how to develop risk strategies and things of that sort. And that was big. So, capital preservation was everything, and it always is. But so one of the software platforms that I have, I developed something called Advance and Protect. So if you Google Advance and Protect, you'll see a bunch of investment advisors out there. They're most likely even current clients, old clients, but I taught the whole industry how to basically protect their assets on the downside by going to cash. What a concept, right?
Yeah, right.
And then also participating when the markets are going up, so trending. So a lot of the stuff I do are trend analysis, those type of things.
Wow.
So I'm a technician. I could go on and on.
That's incredible.
I remember I was in my 40s. One guy said, "You're not old enough to have that resume." I said, "Sorry, I did all of these things." So
wow, that's very impressive. And now, so one of the things that you mentioned is you have a big opinion about what's going on with the banking crisis, because obviously for the last month that's been a big deal. When's the next bank going to fall? Jamie Dimon says the hurricane is on the horizon from JP Morgan. The next banks are coming and the next failures are coming. What say you?
I don't see it. Very isolated. There's a few banks that have problems, and a lot has been made of all the cash flow going to money funds and all this stuff. Yeah. It's not really going to matter to the banks at all. I even saw somebody sent me a text earlier this morning telling me how the Federal Reserve has those losses on their books, and they do. Yeah. But they have something unique. They can print money. They have a direct connection with the legislature, so they can change rules. And I heard actually
that's a good point.
Lagarde say something that really woke me up, just on a clip that I watched yesterday. And she said, one of the things that we're going to be talking about is restructuring debt. And I thought, wow, never thought about that. So like in the commercial real estate world, right? They're just going to restructure debt. Everybody
that's why they're all defaulting.
But no one cares because these guys just trade off. Like, okay, Kevin, you owe me money. It's due next week, but don't worry about it. Pay me 2 years from now. We'll see what it looks like, and I'll give you a break on interest.
And so, in other words, default so you can negotiate to restructure.
Exactly.
Yeah.
But think about restructuring the entire debt of the world,
oh my gosh.
all the central banks, because that she's with the ECB now. but what happens if they restructured all the debt? Let's just change.
So tell me about that. Do you mean all treasuries outstanding and just everything?
So why would they be talking about restructuring debt? Whose debt are they talking about restructuring? I have no idea. It was just a comment, right?
Oh, interesting.
And she's been kind of reviewing a lot of things with CBDC and all the other stuff that's out there. So
and now, does that make you nervous as an investor in markets?
I don't know how to interpret it.
Okay, the debt restructuring.
Yeah, I mean, number one, we don't know what it is. It was a comment. We're going to talk about restructuring debt, and I thought, wow, that's a very interesting thing to do.
Yeah, absolutely.
Because
it makes sense in commercial real estate, and I think one of the things we're seeing is a lot of people are very concerned about commercial real estate. Understandably so. Office vacancy is 50-60% in many cities, and they're very difficult to convert to housing, especially the 1960s office buildings.
Don't convert.
It's impossible.
Yeah,
there are not enough window spaces, egress, everything.
Yeah.
So there are legitimate reasons to be concerned about commercial real estate. But when we hear about, for example, the WeWork default that just happened or some of the other defaults that are happening, are these concerning signals for regular investors, or is that just a normal process of the business?
I would say from a macroeconomic, it's not going to matter. Okay. If there's empty office buildings. I was telling somebody, we're here in LA.
Yeah.
If you count the buildings in LA, go 1, 2, 3 empty. 1, 2, 3. Out of every 10,
right?
You've got 3 of them are empty.
Right.
You get to 10, 3 of those are empty.
Wow.
Not physically, obviously,
sure.
but cumulatively. So I don't think it's going to affect the average Joe. It's not going to keep anybody from going into Walmart buying anything. They don't know what's happening.
Because that's the big catalyst that people are saying is the cause of the next recession now. It's going to be the banking crisis, tightening credit standards, and commercial real estate. We're all screwed. It's going to be worse than 2008, they say. What say you?
Yeah, and I've talked about this on my channel quite extensively. It's just not physically going to happen ever.
You don't see it happening?
No. I mean, because, if you look at what's happened, even if you went back to GFC, right, and go to the whole restructuring. That was a restructuring of debt.
2008
right?
then was
2008.
Okay.
Yeah. So during that time, you just saw everything get. The banking system was restructured. It was, lots of money to start over, kind of do an etch-a-sketch. If they would have taken, there's a couple of situations that would have happened. They would have taken down the whole system if they didn't do what they were doing.
I heard credit cards were an hour away from shutting off.
Yeah. I mean, everything. If the money starts coming out of the machine, it's panic time, right? For sure. If the ATM stopped working.
Yeah, exactly.
And you saw that like in, what was it? It wasn't in Greece. It was another country right there where they only could get X amount of hours, 300 hours a day or whatever.
Sure.
It's brutal.
Quotas or rations rather in terms of how much cash.
Exactly. So once you start that game, you're in trouble.
Then it's really panic.
Restate what that question was.
Yeah. So do you think that we've got the banking crisis, we've got these recessionary fears about commercial real estate? You're saying maybe the banking crisis isn't that big of a deal, but you're still seeing a recession though, right? I mean, everybody's predicting recession.
Zero recession.
Zero recession.
Zero recession. So one of the things, I won't mention any names, but I watched a video on the way over here, and just to know exactly what wasn't going to happen, I won't mention the name.
That wasn't going to happen. Okay, all right.
Because whatever. Yeah, anyway, but one of the things that everybody's talking about M2 collapsing.
Okay, money supply falling.
Nobody is talking about the velocity. It is going vertical.
Really? Okay.
So take a look at those charts. The velocity is screaming. And that's the turnover of money.
Yeah.
And we've been talking about velocity just collapsing for years.
Yeah,
forever.
we have been, exactly.
That's been the dialogue.
I'm actually surprised it's already inflected. When did it inflect? Now I feel behind.
Yeah, well, recently. Actually.
Yeah, just recently then.
Yeah, during SBV and
during the banking crisis.
Yeah.
Oh, this is very recent.
Yeah.
That's a big deal.
And so some people are calling it a little bounce and some kind of reaction, but it's. So on the banking crisis, let me try to unpack something, because the reason why I'm not saying there aren't issues in the banking industry. There's always issues. Everybody's talking about deposits that aren't insured.
Right.
They've never been insured. Nothing's changed.
Yeah, that's true.
They've never been. So all of a sudden, that's the dialogue for the bears to try to get you to go, oh no, they're not insured.
Yeah.
I mean, what bank has ever been insured? It's always been based on trust.
Yeah.
You know, I started on a trading floor where I was yelling and screaming at my friends trying to make money. And everything, if you and I were trading and we agreed to a trade, well, next morning you forgot to turn your card in because it's old paper days. They come in and go, hey, Kevin, I bought so-and-so from you. Like, I didn't buy anything from you. I didn't sell anything. And then it's called a DK. But guess what? I don't trust you anymore. Next time I go in a pit, I'm like, dude, I watched a guy one day in a trading pit for a half hour try to do a market order at the market to buy something.
Because nobody trusted him.
Nobody trusted him.
Oh,
he was done. So you just get black. But the same thing here with with anything. It's trust. U.S. dollar. It's trust, right?
Interesting.
So.
And that's a big thing now too, is people are talking about this de-dollarization thanks to Saudi Arabia now partnering with Iran and maybe denominating some oil and natural gas trades in renminbi instead of dollars. What's your take on that? I mean, is the dollar going to die tomorrow?
Dollar's not going to die tomorrow. There are some downside risk in the dollar, but it's not going. Think about it. How long did it take them to put the euro together?
Oh my gosh. Well, yeah, I mean, that was a very long period of time.
Yeah.
They were talking about that ever since I can remember in the early 90s.
Yeah.
And it didn't come together until...
In 1999, I told everybody, said, well, they were going to have it there, but it wasn't going to be floated until the next year, right?
Sure. And I think it still took till 03 or something.
You basically have doubled the currency on the planet. The euro has to go down. Everybody, no, it's like, no, it has to go down. If you look at when the euro came out, it just went down.
Ah, interesting.
It went down like 12, 15%, like boom. Because you had double the amount of currency
available.
Okay, there's more of it. It's not going to go up until they eliminate one of the two components. It just made sense to me. And so,
relating to the dollar then?
Yeah, so to the dollar, I think what we're seeing is bifurcation of people making transactions. It's kind of already always happened anyway, but it's never been acknowledged. Once again, now all of a sudden it's a thing because, and there have been some substantial deals. I mean, with Macron going over to China and saying some of the things he said the other day was like, okay, what's this about? I need to diversify away from the dollar. It sounds like that was maybe a line that came out of somebody else's script.
Out of Xi Jinping's script.
Exactly. So I don't think the dollar is going to just go away. That's not going to happen because once again, it's trust. Do you actually want to be in the yuan? Do you want to do that? Maybe not. But whether you're some of these countries, secondary countries, I saw actually Larry Summers made an interesting comment on a Bloomberg interview a few days ago, and he said when China offers money to some of these small countries, they offer we'll build infrastructure. How about an airport? Okay, we'll take an airport and some money, and we'll get infrastructure. He said they call the U.S. They get a lecture on how good the U.S. is and how you want to use our dollar. They don't get anything in return except for a lecture. Which you think about it, it's the old, you're going to give me something, I'm going to probably pay more attention to you.
Yeah, exactly. Yeah, absolutely. So this idea of de-dollarization, do you think maybe just now being blown up a little bit in the mainstream media to maybe bag on the current administration or something?
It's probably a combination of all of that. But I think the realities are it's not going to happen. It's not that you couldn't see a shift and a bifurcation of the planet where there's two worlds. There kind of already is. If you look at it, and it's been like that for a long time. They just decided, I think the current administration has isolated themselves so bad, and especially over the Russia's sanctions and all that. They've just, they forced this thing that looked like it is. And of course, I was thinking about Kim.com, if you follow him at all. He's just going crazy on this. The dollar's done and all this stuff, and he's a very smart guy in that, but I don't think that's going to happen.
Now, is it? It seems
it
like
might be because I'm American.
Oh well,
that might have something to do with it. But
I see a lot of people who are super anti-dollar,
are often really into gold, and they're selling gold.
Yeah.
Do you think there's just a bias in that then potentially, or because I think going back to what you said about trust, of the paper money, the dollar has the most trust. It might all paper money might suck, but it's the best of the worst, so to speak, right?
Yeah. You know, so I like I said, I don't see it going away. I don't see that really playing out real good.
So no banking crisis, no dollar crisis.
Okay, so let me qualify the banking crisis.
Yeah.
Is there issues in the banking industry? Yes. Are there going to be thousands of banks fail? No. Why? Because, and if you go back to 2008, everybody had the same trade on. Mm-hmm. Okay, everybody had the same crud. They had assets on the books that were worthless. Okay, they got treasuries. They're not worthless.
Right.
Okay, and by the way, what's happened in the 10-year and all the rates, most of the problems gone
worth more.
already.
Yeah, exactly.
It's already, and in fact, if the right things would have been done with SBB, so I think there was a conflict of interest because Becker was on the San Francisco Fed board.
Right.
All they had to do, and this is what I said when you and I met.
Let that one fail?
Well, no. All they had to do is open up the discount window.
Oh, right.
They said, Mr. SVB, you've got a liquidity problem? No problem. How much money you need?
Which they did
could have
after.
filled the gap. Yeah, they could have filled the gap, and guess what? By filling that gap, it probably would have seen the same reaction in treasuries. And some portion, 20, 30, 40% or more of the issue would have went away immediately.
Immediately, right.
And by Monday morning after SVB, they didn't even have a problem if they just left the doors open.
Wow.
And the state regulators in California shut it down.
They shut it down Monday morning before bank opened.
Because FTC or the Fed has no ability to close the bank, only the state regulators.
Oh, really? Interesting. Okay.
So the state had to pull the trigger. So somebody panicked, they pulled the ripcord, and it was over.
Oh,
you know, and there were others, but I feel like there must have been some kind of conflict that was laying there like, he's on the board and now his bank's in trouble. I worked for a firm that the chairman of the Chicago Board of Trade was also our chairman. We were the largest commodity traders on the planet at the time. Okay, so what happened? We had capitalization issues with our firm. Our chairman is the chairman of Chicago Board of Trade. First thing, he's resigning from the CBOT. Everything starts to implode. Nobody wants to be our friends anymore. Capitalization, 14 days to gone in liquidation. So there were other firms, Man Futures, Refco. If you look at the history of the futures markets, we were the first one to go, and then there were similar type events. So things do repeat themselves, and industries change a lot. But just back to this whole thing, and what I said on that stream that we were on was, all they had to do is open up the discount window. Literally, as I was saying it, the Fed announced they were opening up the discount window, doing a special. I don't know if you recall that.
Oh yeah, Bank Term Funding Facility.
I was really frustrated. For an hour, I was trying to tell everybody, this is all they got to do.
Yeah.
I remember this now. Here they are, and of course we got the rally in the treasuries and blah, blah, blah.
Oh yeah, instantly.
I think, so the banking, back to looking at what it was like in 2008 compared to now, there are no systemic issues. Everybody has treasuries. They're not worthless assets.
As opposed to CDOs from 2008.
Yeah, exactly.
Which were getting worthless because of a real estate cycle for those watching. In other words, those assets were going to zero, where today everybody's got treasuries.
And on the subject where we're, just talking about what the markets, the bond market, everybody's bond market's pricing in stuff. It's not pricing in anything. What it's doing is there's less demand on the back end of the market. So it's going to be lower.
Interesting.
Just think about real estate. You're a real estate guy.
Yeah.
There's not, try to do no one's going to do a refi right now, right? Refis are gone.
Okay.
You got a 2%. Why am I going to go to a 6?
Yeah, of course.
So all of the demand on the back end of the curve is gone. And what you're going to see is the curve is going to start, it's already in a U shape. If you look at it, it's already, the 30 is starting to tick up.
So
everything's going to do a U, and then it's just going to rise a little bit.
Interesting. So how would you explain that to someone watching who's not super familiar with bonds, maybe?
Yeah, so we were talking about the sea change thing, right?
Yeah.
So I picked up something, a comment that Powell said, and it just, wow, it was like he just
Jerome
slapped
Powell.
me. Yeah, Jerome Powell.
Okay.
So he said that we're doing something right now with the interest rate structure that is going to last for decades, and it's going to change how things operate going forward. So I heard that. It's one little.
That was in a press conference, eh?
It was at a press conference.
Okay.
And so when I heard that, I thought, this is, and I've talked to a number of other friends of mine that are very knowledgeable. And this is what I believe is happening. Rates are never going down for a very long time.
Oh, wow.
They're going to stay between, down would be where they are now, 3.5, maybe a print of 3, but they're going to range 3 to 6 on maybe and mortgages are going to be somewhere between
5 to 7.
Maybe it's probably high as 9
at
some point. So why is that? Because the Fed wants out of the game of QE. They're not going to play the game. They've got themselves so far in. All you got to do is look to Japan. That's a whole nother hour we could spend talking about that. But they don't want that. They don't want to be in that game. So what they want to do is this is when I grew up. And if you've been around the markets for 20 years, you think that the Fed runs everything and they adjust the rates and everybody that they're the puppeteer, right? Yeah. If you go back previous to that, the market's always, the Fed, if you go back into the 60s, 70s and beyond, the Fed just adjusted rates to the market. And they want to be back into that game again. They don't want to, they want
rather
the
than
market.
Creating the market.
So yeah, so what is interest rate, right? It's some kind of assessment of risk for me giving you money.
Yeah, exactly.
I need to get paid back something.
Right.
Think about this, depositors will actually get money. You can actually put money in, in a money fund. That's what everybody's doing.
Money markets right now at 4.5%.
4.5%. Why not? Of course you're going to do that, right? Yeah. And that's healthy, actually. It's not a negative, because now people are, they're talking about inflation. Well, that's, some of it's getting offset just by doing that. And then, but if you start to look at some of the, I guess, ramifications of this higher interest rates, it's not there. So I bought a house here in California in 1990. It would have been 1986.
Okay.
My mortgage was 13.25.
Oh wow.
Didn't even flinch. Just that's what the market was.
Yeah.
Housing prices, if you go back and look at housing market, it was fine.
Yeah.
13%.
Yeah.
There were people prior to that paying 15 and 16, and there was a market. It's crazy. It was like buying credit card market, and people were buying houses. And, I wouldn't say money was necessarily easy. You had to qualify.
Yeah,
but
exactly.
it wasn't like, it was in the crazy days in, 06.
06 where dead people can get loans.
Exactly.
Yeah.
Can you sign a piece of paper?
Can you fog a mirror?
The ninja loans. But, I just feel like they're going to restructure this thing. And it's going to look a lot different.
Okay, so I want to unpackage that a little bit. So you're thinking we're not looking at a recession. We're looking at just higher, that what they keep saying, the higher for longer, they mean it.
Yeah, they do. That's what I've been saying.
So the bond market isn't necessarily wrong. It's just not maybe understanding that we're actually going to have this higher for longer.
Priced, and it's a bond market.
Yeah, it's just a market like anything.
People want to go, well, they're doing this. No, they're not. It's just a bond market. It's demand. Okay. There's buyers and sellers.
Okay. So don't read into it too much.
You're looking at a guy that's yelled and screamed and understand price discovery very hard. It's just price discovery.
Because you were a market maker at one point.
Yeah.
So, because people keep saying, the bond market knows all. The inversion of the yield curve signals a guaranteed recession. And that. I mean, what say you to that?
You could look at yield curves and they're not very accurate.
Oh, interesting. Which one would you look at to see the inaccuracy?
I don't know one right
That's
away,
right.
But they've happened a lot. And this particular one, if you think about it, the yields have been all jacked up because they had them at 0. They were never supposed to be at 0. They were always supposed to be where they are now, by the way. Okay. All the Fed is doing is normalizing the yields to how they should be priced in a normal economy.
So this could be a normalization.
That's what I'm calling it.
Interesting.
Yeah. So it's not, I don't see that, like I said, I don't see that the bond market's pricing anything other than demand. If you look at true demand, especially on the back end, 10 years, even in the 5. And the spread they look at, don't care anything about 210s. So I spent from 1992 through 98. I had a consulting firm, and we consulted about 36 of the biggest banks I mentioned earlier. Some of them aren't around anymore. And basically, if you look at the pricing where banks are, it's the 530s are the big spread, and the 510s.
Okay.
Not the 2s. The 2s,
Forget about it.
They're not lending money at 2 rates.
Sure.
They're lending money at 5s to 10s, and sometimes on a 30. So if you like a typical yield at a bank, if I work with banks on their risk management side and their gap analysis, and if banks don't take, they're not supposed to take a risk. They lend money, they do services, they take margins, right? So if you look at a yield on a duration yield in their book, if they got to 7 years, that is so bullish on bonds, it's crazy. So they normally operate between 3.5 and 5.5. Okay. And everybody did get pretty short here, but the Fed kind of said, so you can do, hold forever strategy, right?
Sure. Held to maturity, hide it over there.
Do that, and don't even bother with, we don't care what the prices are, right? And that works. But the second you sell one of those or do anything in that bucket, it now becomes mark to market.
Right. You move them over to
that's
available for
also
sale.
What happened with SVB? They played with that pool. They had to do something.
So So your thinking is, and the bond duration. Where are we sitting now?
I don't know that exact number.
Okay, that's okay. Yeah, that would be interesting.
Yeah, but I think it's still pretty short because of the way it's been.
And you think we go bullish when that goes longer?
3.5, 4 at max.
Okay.
And that's because of the way everybody got structured at the moment.
So for a normal investor right now, if you're not seeing a banking crisis, you're not seeing a big fear out of the dollar crisis, maybe a remaining question or fear would be inflation. I mean, are we going to have 3 waves of inflation again like we did in the 70s? Or
I think we're probably seeing everything pretty stable. I mean,
really?
My title for my video for Friday morning was negative PP, or on Thursday, negative PPI. Everybody thought it was crazy. We got a negative number.
Yeah, we did. Yeah,
big time. You know, and you can see what the algos did trading that day. They had a lot of fun. They, Friday was different.
Sure.
But that was kind of backfilling. But as far as inflation, I think that's another higher forever. I think there's a lot of
it'll stay sticky, you think?
Yeah, I don't know if they get to there was a 2.7 print the other day, so it's kind of hard to say you can't get to 2.5 when they printed 2.7.
Yeah.
But I think that was a one-off report that we saw. I think we'll see things kind of come back into that 3.5. 3.5 to 4.5 is just going to stay there. Rates are going to be 4 to 5. All this stuff is going to normalize because it's got to be priced like it is.
Interesting.
Maybe they fix inflation. Maybe they don't. Maybe inflation just stays because there's so many things because of restructuring after COVID and everything, how things operate. There's a higher cost of everything.
So I mean, that sounds somewhat bearish though. If inflation stays sticky and rates stay higher, we don't go back to the era of, say, easy money policy. Wouldn't that be a potential drag on equities who might be expecting that pivot, so to speak?
1983 through almost 1990, inflation was greater than 5.5%, 6%. That was one of the biggest bull markets we ever had. That was when Prechter was predicting 3,600, right? And that was so if you look at the markets, so yields only matter as when they really truly are not participating in the economy in a structure. So let me explain what I mean by that. Is the way we're structured right now, the economy can just scream. It can just keep going and going. It's not getting, I know everybody's talking about the credit crunch and all that. I think people are just going to keep doing business.
So you just look and go, okay, the rate's 5% now, I'm just going to keep doing stuff.
No, exactly. What else are you going to do? You're going to stop living? Okay, I'm going to stop living. If you have the money, you're going to do those transactions.
And it does seem like people have more money now than they did
Question for you,
before.
what do you see in real estate right now? I know it's...
Yeah, I mean, the beginning of the year popped up a little bit.
Yeah.
Eh? You know, I mean, we had a fall from May to December, but January, Feb, March have been great months so far. Prices have been going up, and partly because people are just buying what there is, and there isn't much. People aren't really selling.
Yeah.
Now, I mean, maybe we'll get Blackstone or some of these larger institutions or REITs liquidating, but so far it doesn't seem like people are really liquidating.
The CRE gets to them enough, they might want to sell some residential.
That's actually a thought that I've had, and I'd be curious to know your thought on that, because my thinking is if commercial real estate plummets, now all of a sudden the cap rates skyrocket on commercial real estate. Why would anybody buy residential as an investment? Those investors move to commercial, you get prices then of residential down, commercial up. You get an equalization.
Yeah.
So commercial tanking should drive real estate residential down.
I'm arguing the commercial taking, if I had a lot of money, I'd be buying these properties. I don't know what I'm going to do with them, but
You'd be buying commercial?
Yeah. At these
as the prices are going down?
Yeah.
Okay. Into the fear, or now, or would you wait?
If you did that in 08 and 9.
Oh God, yeah.
Which I did.
Yeah.
Okay. It was the best trade you're ever going to make. So you know, if you're going to buy low, sell high, it looks like they're setting up the low. It doesn't mean it's going to bounce tomorrow.
Sure.
But you know,
where do you think the low is?
I have no idea.
Yeah.
It's not my market.
Sure.
But, my brother's in multifamily, and he was telling me that it's worse right now in multifamily than it was in 08,
Wait.
09.
What? Tell me more about this.
Meaning that the only deals that are happening are deals that happen. Somebody's got, you know, the 403 exchange.
Oh, 1031 exchange.
Yeah,
Yeah.
1031s, yeah. It used to be called something
So you said
else.
your brother's in multifamily real estate. Okay.
So, and he was just saying there's no loans going on. The only deals are happening are somebody that sold out of something and they got to buy something.
trade, sure.
So there was like a property the other day, there was like 60 bids on it.
Oh my gosh.
On one property.
Wait, but how is it worse than 08 then? I mean, it sounds good.
There's no financing. The cap rates haven't changed. Nothing's adjusted. So you can't put a deal together. He goes, there's no way to put a deal together and make it work. You know?
Yeah, exactly. It's
Something's
all
gotta change.
overpriced, in other words.
Yeah, exactly.
So is
But
he
most of the-
forecasting a fall?
Most of the multifamily is me trading with you and say, hey Kevin, I bought this property 4 years ago. You paid this, and then they just kind of trade amongst themselves.
Greater fool, almost.
Yeah,
I
they
hate to
really
say it.
do.
Yeah.
I mean, there's a lot of these things have. I mean, these guys have rolled when the zero money was going up. You know, they've rolled, you know, 50 million to 200, 300, 400, 500 million dollars. Big numbers.
Absolutely.
Yeah,
Yeah.
and they're buying, you know, 12 unit properties and 36 unit, not the big, you're not buying 2,000 unit.
Oh, sure, you don't need to.
Yeah, you don't.
There's so much opportunity in real estate, and I think
Especially
we'll go
like
through that again.
Like here, there's all that is everywhere, right?
Yeah.
And so, yeah, I think, I guess to summarize where we're at here is, I just think that we're going to see this is the sea change.
Normalize.
So the sea change was when Volcker came in, when I started, right? So we went through these crazy rates trying to kill inflation.
Right.
Okay.
Restoring that Fed credibility.
Yeah, we got to the 21% discount with a 4% penalty if you showed up the discount window too often, which everybody was. So it was literally 25% yield.
I mean, today I think it's 25 BIP penalty.
Yeah, I have to
or
quote.
less.
I have to quote Dr. Baker on this because he was running the Penn Square Bank thing I was telling you about. Yeah. Well, the guy that was running Penn Square Bank was bragging to Baker. He goes, "Baker, I'm doing all these loans, and I'm getting 25%." And Baker's laughing. He goes, "I'm buying treasuries and getting paid 17
with no risk."
And my loans are guaranteed by the U.S. government, and you're never going to see a penny on those 25.
Sure, because they're going to refinance them all.
They're not even going to refinance. They're just going to default. And that's what happened.
No way. Are you serious?
If you look at the Penn Square Bank, they didn't get paid on all these aggressive loans they were doing. It was just the massive defaults.
Oh, wow.
There was also an oil thing in there too, because that was, if you go back during that time, crude oil was like under $10.
Oh, yeah.
And so what happened is a lot of the oil patch stuff in Denver and Oklahoma, they were financing this stuff at these crazy rates.
I see. Yeah.
So it just blew up.
Of course.
You know? So.
Well, sure, the price of oil goes down. They can't make their payments anyway.
Right.
So, okay, so first sea change, it was Volcker, 79.
Yeah.
Was when he was appointed. So early 80s, first sea change.
So
and that's normalizing Fed credibility.
Pretty much.
Okay.
Yeah.
Okay.
And again, actually really attacking inflation.
Okay.
Because everybody said, who raises rates during, recession? Volcker.
Volcker, yeah, exactly.
And he raised them aggressively.
Well, because
right?
Burns before that was under the impression that we'd rather tolerate higher inflation than have people lose their jobs. Volcker flipped that.
You bring up Burns. He's on my list as the worst Fed governor prior to Yellen. But that's another story.
Prior to Yellen. Oh no. Okay. All right.
But I didn't know Yellen. I used to say that back when in my early days in the markets. But
I'll have to show you my pictures of Halloween 2 years ago. I dressed up as Jerome Powell. My father-in-law was Janet Yellen.
Oh, that's funny.
And we gave away money with candy.
That's awesome.
Because inflation was transitory. Was our argument. It was then. Anyway. Okay. First sea change, Volcker. Second sea change.
.com.
.com bubble. Okay.
Everything was restructured again over what was Greenspan's word? Exuberance, something.
Irrational exuberance.
Irrational exuberance.
Okay. .com era. Yep. Okay.
And so that happened, and then of course
08.
And
real estate.
Now we're here. The sea changes aren't necessarily crises. They are the restructuring of how rates are working, and the Fed has a lot to do with that.
Sure.
Of course, right? But like I said earlier, what they're really trying to do is they want the market to be the rate structure. What's the demand? What kind of risk is out
Stability.
there? Yeah. I mean, that's why, and I think what you're seeing, like even in the 10-year, that's why we printed down, down to low threes. It was amazing. I mean,
3.3.
I was on my channel one night going, I'm getting projections to go to 3.25. That's nuts. And they went to 3.25.
Yeah, they did.
And I thought it was just completely, I have to, my work, my quantitative work, I do what I do. And that's what it was saying, And now it's saying probably 365, 370. It'll stabilize in between where we are now.
Interesting.
So it looks like we're just going to flatten out for a while. How long that lasts?
Now, I mean, so inflation, what if it turns out to be transitory and inflation does end up going back to 1.5%? Rates come down?
Possibly.
Yeah, but you don't
But
believe
the market's going to determine that. Because think about that. If that happened, that would be the case. I can tell you where I live in Arizona. They just went to the second that they cut oil production. There's one distributor just jacked their rates it's like there's some guy in headquarters going, oh, they just did this and they just jumped it 10 cents. We're up over $4. I know that would be cheap.
So,
you would like to buy gas for $4.
Yeah, no kidding, California here.
Yeah, but
so you're saying OPEC plus cuts, somebody instantly raises the prices.
But when they go down, it's trickle.
Yeah,
right?
yeah, sure.
They're just playing the margin. So I just like the way I see the world right now. I've been doing this for 43 years, so I've been around a few days.
Yeah,
and I went through every one of those guys, starting with Volcker when I started in the business. So I've watched every Fed.
Yeah.
I got to see helicopter Ben up front. Right?
Ben Bernanke. Yeah.
I mean, it was those were crazy times.
Yeah.
And actually, Yellen, I kind of trolled her a little bit there.
Yeah.
But Yellen is the only Fed chair that never had a crisis under her.
That's a good point. During the end of the Obama era, there. Yeah.
She never had one. And
true.
my pitch back then was, every one of these guys get something happens.
Except her. Interesting.
Except for her. It never happened. So I'm
more women Fed, please.
Yeah, I don't. I think really what was happening then is it was the stabilization after everything, all the money that had been added, and there wasn't really, for whatever reason, there wasn't any crisis. I'm a little worried about her at the Treasury.
Well, it's very politicized there.
It is very politicized, but even then, if you look at the Treasury bank account, it's pretty much tapped out because we got the debt ceiling. That's a whole nother thing. But that's gonna get raised.
Of course, yeah.
Everybody knows that. Yeah. It's just they're gonna have some kind of drama around
to negotiate.
Well,
they have to make it look like they put up a fight.
Exactly. No, it's true.
Yeah.
And so that's not. I don't see that as being an effect in anything that's going out there. I mean,
so it sounds to me like you're not terribly worried about recession, dollar crisis, China, really inflation. What you're thinking more is just get used to the numbers where we are, and this economy can keep going.
I would tell you that all of those things you mentioned, any one of them could rear up and be an issue. Just
They're not now.
They're talking points, and the markets are with the algos trading, and they can trigger them very easily.
Sure.
You get a lot of activity in the markets, and when they come in. The other thing, there's a dynamic that's happened in the markets. I haven't been around for a long time. When I started in 1979, the volume on the New York Stock Exchange was 40 million in a day. That's a nanosecond on Monday morning. Right?
Crazy.
So it's just. But the point is that markets have evolved. Then after COVID, we probably doubled or more the amount of people that are participating in the markets.
Wow.
And the other thing that's helped that happen, and it wasn't just Robinhood, but it's fractional shares.
Sure.
So my favorite line is, investing used to be for someone, now it's for everyone. And the reason, so that's it. And I have a little podcast I did in 2019. I went to Charles Schwab convention for institutional convention down in San Diego. And I was watching, and they were announcing that they're going to do fractional shares. And I said, what we're going to see is, we were doing about 1 billion shares, roughly average per day. And what we're going to see is we're going to see volume quadruple. Now we're doing 6 billion.
Wow.
But if you look at 2020, after all that, I mean, I was literally there just weeks before the pandemic hit, right? But once that happened, everything went crazy.
But isn't that a good thing though? Because you have more liquidity.
No, it's a very good thing.
It's
a very good thing. And and the fractional shares has given access to markets to people. And unfortunately, 2020 made it look like it was easy.
Yeah, of course.
And it's not so easy. And I remember proclaiming it in 2021 that the easy money's over, folks. It's back to work.
Back to normal.
Yeah.
And that's these higher rates, maybe higher inflation.
Yeah, and you look
stickier.
at what happened to meme stocks, all the Kathy Wood stuff, just really bad. So
you're not a fan of Kathy?
Do I say it?
Well, how about this? What do you think about the holdings in ARK?
I think she's one of the worst portfolio managers I've ever seen.
Oh, wow. Okay.
Why? Why do I think that? It's just, she just buy the dip. She has in her documents. I was really thrilled.
Yeah.
So I rebuilt ARK in our software platform, right? I took all the stocks. And she's she gets very heavily weighted, and then she's committed to her ideas, which is admirable, I guess, if you're an individual investor, but when you're managing other people's money, she dropped almost 80% off the peak, right?
Sure.
So you can't run money like that. She just kept buying more and more and doubling down, quadruple, whatever.
So from like an advising point of view.
Yeah, I mean, if you're running, which I know you've got your fund running now. If you're running money, you want to make sure that you can manage the volatility.
Yeah, exactly.
And volatility is everything. And from you as a business person trying to grow your fund to the guy that's investing in it, right? So you have to manage that, and it's a really important. It's not just through diversification. If you just a real quick comment on ETFs in general. If you look at every ETF, they're heavily weighted, and then by the time you get to the bottom, there's just a couple, maybe 1% of something.
A few BPs.
And if you invert most of those, I do something called ETF hacking.
Okay.
So I'll take all those.
ETF hack.
Yeah. So we go in, we go into our software, and basically, for the most part, the weighting gets flipped upside down.
Wow. So you put the smallest positions as the largest?
Well, what happens is most of people are going to invest on what they think is going to move the most. So they heavyweight that front end.
Of course.
And if you're wrong, the volatility goes crazy.
Of course.
But it's interesting because some of you would think was my least likely pick is a really, really good pick if you look at them.
Oh, interesting.
So I look at the bottom end of these funds a lot of times.
Really?
Yeah, especially like we did an XLE hack in 2001. Easiest trade on the planet, right? Buy energy, right?
Sure.
Nothing smart about it, other than it was an easy trade. Okay, and it actually goes back to 2020. In November 2020, I was telling everybody financials and oil.
Wow.
That's where you want to be. That's where you want to be. Energy, that's the sectors you want to be playing in. And they were, obviously, you're going to come out of the pandemic at some stage. You're going to have the oil demand,
That's gonna
financial
come back, of course.
activity, but, you know, the two very easy trades that everybody told me I was wrong on, which I was very right on.
Yeah, good for you.
But the ETF hack was up over 40%.
Wow.
You know, in 21, which was not a bad
great.
year, but
That's great.
you know, it didn't. I don't think it was. Everybody wasn't going to like concentrate, but that's my other strategy. I do like concentrated strategies.
Wait, but on one hand, you're saying take the smaller ones and diversify them against the
not
bigger
diversify,
ones.
make them the bigger trades.
Oh, you're just saying literally
I
flip
almost
them.
flip it. Yeah.
So you're just saying take.
So if I put our software on there and we ran this,
Yeah.
chances are the weighting is just completely different.
Well,
So-
but that's just a different opinion then. But what you're saying is flip the you look at the ETFs and you take, let's say, something that's a 1% allocation versus something that's a 10% allocation, and you would flip those potentially.
Based on if they were trending, if they had a signal that would.
All based
suggest-
on the TA.
Yeah.
Ah, okay.
And on the quant stuff, yeah.
Ah,
So like we run 10 million calculations every night in our database.
Oh my gosh.
Every symbol has 600 variables that it looked at every day. So, and we've been running this process since 1997.
And do you just refine this software every day, or how do you adjust the software?
It runs every night. It's got allocation process. It's very interesting because it basically is rebalancing. We built something called dynamic profit harvesting, where you literally you take stuff off the stuff that's growing the most.
Sure.
When you have a new idea,
Yeah.
you take from the big guy.
The winner.
Yeah.
Uh-huh.
And then you put it into the new idea. So the concept is the one that's growing the most is probably getting to the end of a cycle or closer to it. The new one has got a brand new cycle. It's got more probabilities. It's got more possibilities of growing.
That's a good
and
point.
so what happens, it literally causes an acceleration of growth of capital.
Wow.
Yeah.
So what would you advise to sort of a regular investor watching now?
Yeah.
If they've got, cash and let's say if they're 50% cash right now, do they stay cash heavy now? Do they go into stocks, real estate, bonds?
Yeah, that's being who I am, being a quant. First thing I would do is go to my software and see if I like this stuff.
Yeah.
I think individual investors have an opportunity to actually go in and do some analysis on the stocks that they like, and then find some kind, whether they're using TA or whatever they're doing, find some kind of concept that they can back up, whether it's fundamental, understand what you're involved in.
Sure.
That's a simple rule, right?
Yeah.
Everybody should know that, but everybody doesn't know that. And, probably don't watch too many podcasts and
Too many different
suggestions.
ideas, huh?
Yeah, because that goes back to what we were talking about earlier about, be careful what you read, you might believe it, right?
Yeah,
Same
sure,
thing with,
sure.
and I do daily streams every day, right?
Yeah,
So
yeah.
I'm in the opposite scope, as I told you. I'm on at 9:30 at night. So I do pre-market setup for what's going to happen the next day.
The night before, yeah.
And we have something called a market grid, and it actually predicts where the ranges is going to be.
Ah, nice.
So we have it's really interesting. So I'll put out there it's going to be S1, support 1, R2.
Yeah.
And they're crazy accurate, and
Wow.
they're developed. It looks like when you look at it, maybe like a Bollinger Band when you first look at it.
Sure,
But
yeah.
they're not standard deviation based.
Okay.
And they're volatility based, and they have some Fibonacci calculations that are going, here's where the range is. I actually built that indicator for my institutional accounts when I was working with banks, because we were working with gap analysis. So if you were a bank and had long liability, you needed to sell some of it off, you would look for the exact point where you would try to, you need to sell something. So we developed, here's the best possible price for you to sell for that day, because these guys have to do something. It's not something they want to do. So
Wow.
because they're hedging.
Yeah, exactly.
So I've got new pipelines, especially we worked a lot on mortgage pipeline stuff. And you've got mortgages just came in today. Do I want to hold these like they are, or what kind of risk, what kind of duration do we have? So then, okay, if I need to sell something, we would develop a price range where these are your target price range for your sells. Here's your target ranges for your buys.
Wow.
And then we just started to evolve out to use it for other markets. Started predicting ranges
For everything,
every day.
for individual securities and everything.
Everything.
So, on the market broadly, bullish or bearish? S&P 500 2023.
Very bullish.
Very bullish.
Yeah, so give you an example. I have the database that I'm talking about right now is 63% of all the stocks are long. So some people look, stocks that might be over the 200-day moving average. That's just, the fact that they're over the 200-day moving average doesn't mean they're trending. It just means they're above the 200-day moving average.
Right.
So everything I do is trend-based. And so I have right now about 10,000 symbols in database that are suggesting that they're going to go up. But guess what?
63% are up.
Yeah.
Or
So I have a map on every symbol. So I can tell you how long we normally hold, what the returns are, what the deviations, every stat you have forward looking. So one of the things I talk about on my channel is what percent bullish are we? So there's some magic numbers. I won't talk about that, but it's too detailed. But at a certain level, there's enough traction in the market, it's not going to go down. I told everybody just the other night, I'm not going to be wrong 9,600 times.
Wow.
Okay, that's not going to happen.
Yeah.
Probably 60% plus will work. And some are going to be spectacular trades, some are going to be moderate trades. But the overall market, so there's a forward-looking component. So we know that on our intermediate models, the average holding period is like 220 days, 230 days.
Yeah.
That's a year.
Yeah.
Better part of a year, right? So all of this stuff.
Especially if you're talking trading days.
Yeah, they're trading days.
Yeah, yeah.
So you're looking out a year. So we started buying. First time we saw anything was in October, right after
near the
October
bottom.
lows. But we were last in 22. We were in cash for the most part of heavy cash all year long.
Wow.
And then we come in the fourth quarter, we start getting buys. And so we have short-term buys, which are 35 to 50 day hold. And then we have the intermediate, which are 200, we'll just say 200 plus.
Yeah.
So when the 200 pluses start to come on now, these are real, they're material. And so right now, our forward looking, there's still, I think just off the top of my mind right now, is we still have maybe 120 to 150 forward-looking days positive.
Wow.
So I'm thinking we're not going to have any even things to talk about till Q3, maybe middle of Q3, and then you can go, okay, let's see what's going on.
Because that's where everybody keeps saying the recession is going to be.
And I understand that. So, and I can tell you that's where our models are projecting a point. But what can happen is, so with 16,000 symbols, we're going to get a rotation. So these things can kind of refresh the stats. So some things get sold off, they go down for a while, they get bought back in. And so it rotates. So I'm always looking at these stats.
What are your favorite sectors now? What are they saying? Your models. What are your favorite sectors right now? What are your models?
That's good. I wish I'd have looked at that a little closer.
That's all right.
But
bearish staples, commodities.
Yeah. I'd have to look at it.
Yeah,
I wish I'd looked at
that's
that before.
Right, yeah.
I just, I don't have an answer for you.
No.
But there is that I can tell you this, that of all the sectors that we follow, we built all of our indexes are custom. They're not anything off the shelf. It's all custom built. But right now, I believe there are 8 of the 11 sectors are bullish right now. And there's certainly some favorites that look better than the others, but I did not review it.
So if you're,
wasn't ready for that one.
Let's say you're 25 today and you've got some cash. Do you buy a house? Do you go all in on the S&P 500, the NASDAQ? Do you get a better job? What do you do? All of the above?
Buy a commercial REIT that's in, no, I'm just joking.
Yeah, okay.
I shouldn't make that joke.
Oh,
But like I said, if you're going to buy low.
Yeah,
listen, I think the stocks that I've been talking about a lot is I think that the Russell's going to come into play.
Small caps, okay.
Yeah.
What are your favorites?
Don't have any.
Okay, just Russell in general.
Yeah.
2,000 small caps, basically.
You have to understand, when we're looking at stuff, we have so many metrics to build things with.
Yeah.
So
Well, you're TA. You don't like the earnings calls as much, eh?
Yeah, no, earnings are bad. You have to understand, I worked in 2 institutional research departments. You never want to listen to anything they say.
Is it just all marketing?
I was trolling Ed Yardini the other day.
Yeah.
Well, I worked, Ed was our head, in the 80s, he was our head economist.
Sure.
And we just faded him. He was the best fade trade that there's ever
Really?
been.
Because he's got the Yardini
he's
report.
almost as good as Kramer.
Stop. Oh my gosh.
I'm serious.
Oh my gosh.
And somebody said they quoted Ed, and I go, well, now I go, he's actually improved. He's only mostly wrong, not always wrong.
Oh my gosh. So wait.
But that's typical of economists. If economists could trade, they'd be the best managers in the world. They can't punch himself out of a wet paper bag. Okay.
Yikes.
Yeah. When I hear that stuff,
Yeah.
yeah.
Okay.
I
So
can't go there.
not a fan of earnings calls because it's all sales marketing.
Well, yeah, because think about that. I always put this out on earnings, right?
Yeah.
So what's really going on? Are these guys understating so they can get a pop in the stock?
Sure.
The companies are always trying to do that, right? It's a marketing.
Yeah.
Every research report you ever see, having worked in 2 major institutional firms, they're marketing reports.
Sure.
They are not have anything to do with what's likely to happen.
Oh my gosh.
That's just my opinion.
Do you feel that way about sort of mainstream media as well?
Absolutely. Yeah.
So what's your favorite? New York Times, Wall Street Journal?
Yeah, I don't read papers.
Oh, not at all?
No.
Bloomberg, anything?
I'll watch some things once in a while, but I isolate pretty good.
So staying away from sort of that mainstream, instead just focusing on your algos and that.
Yeah, that's it.
Wow.
So, yeah, I think, I think too much is trying to read. I actually watched some Kathy on the way over.
Oh,
That's who
really?
I was watching.
Okay.
And that's who I was trying to figure out. Here's what's not going to happen. But one of the things that she has the same dialogue everybody has. We're coming in recession, the M2 is dropping, blah, blah, blah. These are common type things that are going on. And you have to understand, I'm an old trader, a little bit of a contrarian. But if everybody's saying it ain't going to work,
Interesting.
it's not going to work that way.
But she says $1 million Bitcoin. Your take?
No idea.
Not into
I'm
crypto?
very bullish on Bitcoin right now. But
Okay,
I
bullish
don't
on
know
Bitcoin.
about $1 million.
Okay.
So this was like, if you could ask me, Bob, what do you think the market's going to be in 27, right?
Yeah.
Who cares?
Yeah.
Would be my answer. I can't trade it.
Yeah.
Am I going to put a trade on today thinking about 27?
No.
So no.
Yeah.
So,
But bullish Bitcoin right now.
Yeah, I have been. Yeah.
Okay.
I could show you. I think we had a signal at, I want to say 15,000 have been long.
Yeah.
16 in
Yeah.
that 15, 16 range is where we picked this thing up. And got objectives. I've been talking about 31,000 and we're printing.
Here we are.
No one thought that, I don't know if no one thought, but, I think, everything I do is really just all off. I'm a very unique guy because I built a platform.
Yeah.
Think about this. I've monitored 16,000 symbols.
Yeah.
All of the symbols are executing my exact models that I built back in the 90s.
Yeah.
And I've been following them for 3 decades.
Hmm.
So where's my confidence come from? From
those. So how did you put one of these together? Like, how does one start making their own model in your version? Like, if you were to start over right now, what would you start with?
I don't know. I was very lucky. I built some, I've been very lucky with some of the mentors I had.
Okay.
I had an old client that was a professor at University of Michigan, PhD in physics.
We get the sentiment surveys from them.
Yeah, I do. And, but Bill came up with the concept. So I have a PhD plus in moving averages. I know more about moving averages than most people will ever want to know.
Okay.
And I've used 3 moving averages for almost since 86.
What are your favorites? EMAs or just MAs?
Now, 1021 simple, 1021 40.
Okay.
I implemented the 200, which I found to be useful, but we do something unique as we run indicators on the internal change of the moving average. So this is the big dilemma, and this was our dilemma.
It's a derivative of the moving average.
Yeah, we're looking at first, second derivatives of the moving average. Okay, so and trying to determine, and we built a probability map. Okay, so here's the big thing that everybody's looking at. Here's the 10 peri moving, whatever average, and the market's coming down to, is it going to hold? I don't know. We'll see, right? I can tell you if it's going to hold. I can tell you what the probabilities are if it's going through or if it's going to bounce.
Because of the three together.
Because of the probability map and what the basically what that percent change in the angle. So I talked about angle of attack.
Yeah.
Angle of attack is an aviation term.
Sure.
Okay. So, but it's the same thing here. Once the angle gets to a certain level, the probabilities of going through start to drop. So once you get above a certain angle, that's when you see the steepness. And I have 3 different versions. There's one what's a typical where we get to some kind of terminal value and then it comes back. There's another one where we can get extended patterns are likely to happen. And then the last one is a parabolic curve, which is vertical, right? So there's numbers in there that will tell you what's going on.
Wow.
So those are the core understanding of trends.
So when does it go wrong?
I don't know. I mean, they're just trades. So,
I mean, not all trades work.
No, they don't. But so you were talking about building a model. I think it's very difficult because Bill and I for years, and then I went on my own. The nice thing is I was probably using a program on DOS 2.3 at the time. Yeah. Okay. And there weren't very many programs out there. There was one called CompuTrack. And CompuTrack was the very first program out there. And they allowed you to build your own indicators. You could do custom stuff like, 2023 kind of stuff to a point. And so we had this dilemma about the moving averages. How are we going to figure out when it's going to hold and when it's not? We needed that answer. Everybody needs that answer. So we we just focused on getting that answer. We're also Elliott Wave folks. So my deal I talk about is wave tech. So wave tech is a combination using moving averages, angle of attack to determine probabilities of change and where they're likely to go. So that is the crux of everything I've done for my entire, literally since 1984.
And so does that mean I understand you're trading, but when you believe that what Cathie Wood is saying, let's say, is not going to happen, does that make you anti-innovation or just anti-trade?
Innovation's fine. I don't have a problem with that. It's just the stocks. The
signals are wrong.
They have to do something, right? You can't just go down forever and keep talking about this as a good stock.
I see.
Those good stocks don't go down. So I've never seen stocks that collapse. There was somebody I was following. And I get blocked. Sometimes I can be a little trollish.
That's all right. We love it. Twitter is entertaining.
It is. Yeah. And there was a guy on there, young guy, and he had all Cathie's meme stocks and all the stuff on there. And when they started to collapse, when it got really ugly, and I said, you realize that most of these stocks are never coming back.
Wow.
They're not ever. I don't care. You can talk about their income. You can talk about everything. They're not going to come back.
Wow.
And you can actually get a view of that world by looking at like crazy penny stocks, like OTC pennies.
Sure, yeah.
Those things, they get that big curve, they collapse, they're done.
They're never coming
back.
Because
think about what happens to a company when that happens.
Oh, they can't raise capital.
They can't raise capital, they can't finance, they can't do anything.
Yeah, their interest rate goes through the roof, they're screwed.
It's done. So when you see that collapse, good companies don't do that. And I'm not saying they don't have good ideas.
What about Tesla?
Great ideas.
They fell 60%.
Tesla did fall 60%.
Yeah. Does that make them a bad company?
I wish Elon would have bought Mercedes-Benz instead of Twitter.
Yeah.
That would have been the deal of the century, whatever.
Do you think Tesla falling was mostly because of his Twitter purchase? He sold somewhere around 24 billion in stock.
I think Tesla has always been pretty overpriced. For the most part, it's pretty heavy. There's some risk in Tesla, not major risk at this time, but there's some downside.
What about, so talking on Cathie's, she's into Roku, the Snowflake. What do you think of some of these?
If I brought them up on a screen, I could. We had some live charts I could go into.
That's right, because you're not looking at even the cash flows or the fundamentals, really. It's just the trends.
Yeah. So when we're building portfolios, we do look at fundamentals.
Okay.
So we have a screening service that we offer as well. We have full service, everything, because we have institutional clients.
Yeah, sure.
So we have a bunch of screens that you can use.
Wow.
And so, yeah, and fundamentals are important.
Yeah.
And none of those companies, I don't think, have really good fundamentals.
Got it. Okay.
Because there's no way these stocks are going to come, like I said, there's.
How do you recover?
We used to have when I was on the Pacific Option Exchange, we say, don't ever play with stocks that have trouble because there's too many good ones. So if they got problems, don't try to solve their problems. Don't try to play in them. We were trading AMD back in the day, right? So what would happen is Intel would sue AMD every time they put a new chip out. Intel would sue them. AMD would go from 22, 24 to 12. Okay. So you bought 12s and you sold 24. They would do that. Literally, it would take about 5 or 6 months. You'd start to get reports. Everybody's watching. The lawsuit, and then all of a sudden it gets turned over, dropped or whatever, and boom, back to 24. So we were option traders, so we just put these big straddles on.
Simple.
And maybe do 2 to 1 on the long side or 2 to 1 on the downside, or
depending on which side you were.
Maybe even a lot more because we had 90% ability to margin up to 90% as market makers.
Sure.
So
wow.
But yeah, so I think good companies reveal themselves and are pretty easy to follow. So you should know what the fundamentals are.
Absolutely.
I'm not saying that's not that, but the technicals and not just TA, but some of the other quant stuff they have. So like if I had my software here, we could bring up a stock.
Yeah.
And I could go, okay, this stock normally holds for 180 days. It normally makes 32.1. Here's standard deviation of that return. Here's the average loss. How many days is it in a losing trade versus a winning?
We'll have to play with that sometime.
Yeah, we will.
So what about, so having been a market maker, what say you about the Citadel and maybe the fail to delivereds and the short selling and the naked shorts?
AMCs and
the GMEs. Yeah. What do you say to the apes?
It's really, listen, it's tough. I don't know that world very well, but there's lots of wrong there.
There's a lot of shenanigans.
Yeah, it's not good.
Yeah.
And Citadel is a monster. There's no doubt. But you couldn't live without them.
That's a good point. Okay.
And most of the algo trading that's going on in the markets, people say it was 70 or 80% of all the trades or more. Yeah. Most of that is pricing models, meaning bid ask that you're seeing. That's where most of the algos lie. They're not all trading the markets, playing long or short. Sure. They are doing that.
Yeah.
But the biggest algos are the pricing algos.
Okay. So there's an order book, in other words, to maintain liquidity.
And I can tell you, I once upon a time was able to take a 12-cent stock and bid it to 22 by using some market making tricks that we used to do. And and then because there's certain things, especially when you have level 2 screens.
Oh yeah.
And you can see who's playing and see if anybody's real out there. And they can watch as soon as you start to raise some bids, the offers kind of tail off. The same thing even with E-mini trading. Like I teach, one of the things I talk a lot about in like day trading is watching the order book. The order book tells you what's going on.
Yeah, sure.
I still hear the pit in my head. So the guy, there's 200 offered. I hear the guy screaming 200 at whatever. It's just like you can see and say, let's see if this guy's real. We get a little close. All of a sudden the 200 goes to 120. It goes to 80, 60. It never traded there, but the offer disappeared. And then you get the flash offers. Somebody throws out, 300, 500 for sale at a price.
Right.
And everybody go, the big sellers out there.
Interesting.
You don't know if they're big sellers or not, actually.
Right.
They're
a lot of gaming.
Yeah, it's a game.
Interesting. So in the past, if you were able to do that with, say, a 10-cent spread on a penny stock today, it'd probably be easy on a $100 stock to easily manipulate a few pennies here or there at a large scale.
Yeah. So price discovery. You want to talk about price discovery?
Yeah.
Okay. So most people think volume moves markets. Okay. Volume does not move markets.
All right.
You have to have volume, but that's not
to function. Sure.
It's the aggressiveness of the buyer or seller that moves markets. So let me explain. Okay. So it's bid at a half. I'll just do at 5/8, right? So make it easy.
Okay.
So I've got $1 million to buy. You've got $1 million to sell.
Right.
We're not showing our size. I got 200 at a half, you're 200 at 5/8, right? Okay. We're looking at this old pit days, right? We're looking at each other and I go, take your 200, raise it to 5/8 for 500.
Yeah.
I just raised the bid. I just raised the market by an eighth.
Sure.
And you go 3/4. Buy your 3/4 bid for 500.
Yeah.
Because I got a lot of stuff to buy here.
Yeah.
I've only done 400 of my order.
Yeah. You still have a lot of work to do. Yeah.
And I got these guys running already. So that's how you figure it out. But and you'll see it, like if you watch a level 2, like I live in front of a E-mini screen all day with the level 2. And when you look at that, you can see this happening. All of a sudden just like that with the, sorry for the noises, but it just kind of just, all of a sudden it just goes up right away. And you get, it went from 100 points, 200 points in the futures, just like that.
Wow.
And then all the cash, SPY, everybody's got to play catch up.
Yeah.
So everybody's running in there. The ARBs are trying to balance everything out. And, most of it's happening electronically, but it's still a lag.
Wow.
But what happens is that exactly that, where you're just taking out the offer and you raise the bid to the offer.
Sure.
Take out the offer, raise the bid. And you just rotate it up.
Manipulate it
and
up.
if you got size.
Yeah.
And
you could do that all day long.
Back in the early 90s, there was day trading rooms that were out there. And they would call them group trading rooms. A buddy of mine ran a really big room down in Houston. Mm-hmm. And they called it, what do they call it? Team trading. One of the guys in the room, they called him Wamu. He was the biggest trader in the world in that room, right? And Wamu would go, I'm going into whatever stock, right? I'm going in to buy something. And everybody in the room pile in, just start buying and doing exactly what I'm talking about. And meanwhile, Wamu is the first guy in. He's selling out.
Sure.
Yeah.
Of course.
So.
Well, because, really thinking about it, if let's say, I don't know, somebody's selling lemons at a lemon stand for $10 a pop or whatever, somebody comes in with $1 million and they wanted to increase the value of lemons, they can buy them out at $15 a lemon or whatever. All of a sudden, all the lemon market just went up.
Yeah.
And now if they have a bunch of lemons, they could start dumping to all the people thinking it's running.
Exactly.
It's essentially what you're saying.
That's it. And on an intraday, but that's what's going to drive it, the aggressiveness of the buyer. That works same on the sell side, right?
So that's why somebody like Citadel has a lot of money. They can be as aggressive as they want.
So their algos could be set to be very aggressive.
Yeah.
So why would they be aggressive? Because they have a lot of inventory.
Sure.
So they got a lot of stock. The old days used to have OTC market. NASDAQ would like call up a guy on the phone. And the joke was if the markets were really bad, the phone would ring and ring and ring. And they would never pick up the phone, right? Mm-hmm. And squeamishly, sometimes they'd pick up and go, okay, we're at a half or whatever. Yeah. How many you got, And you would have those conversations. But now the way the markets are working, this digital world is way, way different.
Yeah, much faster.
I tell everybody, if I tried to do the type of trading I did in a live pit, I would get punched out.
Oh, wow.
Because doing what I just talked about and people around you losing money because you've got big size and you're bidding this stuff up, and that happened.
Yeah, wow.
There was a guy in a gold pit in 1980 that he traded, I'm trying to remember who he traded for, one of the big dealers out of London, right?
Okay.
He could control the pit at any moment. Everybody would follow him, right? But he would get the whole pit bid. Everybody's buying, right? So everybody's bidding, right? And he'd come in with this sell order and just like sell everything.
Oh, wow.
And everybody's like, wait, now there's
nobody wants to buy anymore.
Yeah. They're the bag man.
The literal bag holders.
Yeah.
Wow.
And that would happen, and maybe it was only 50 cents or $1, but everybody's the whole pit is like a shockwave.
Wow. That's incredible.
But price discovery is done by the aggressor.
The aggressor.
Without a doubt. And there could be a lot of volume. Oh, other example is we each have a million to buy.
Yeah.
And I go, million to buy 5/8, you go, or buy at a half, and you go million at 5/8.
Yeah, sure.
We yell back and forth 15 times.
Yeah.
One of us finally goes, I really want to buy them, so it's going to go 1/8, and that's going to be it, and 1 million shares are going to trade.
Right.
Where the other example, maybe I only use 400 or 500 of them to bid up, and maybe raise the price by a quarter.
Yeah.
And now everybody's sitting at their little screens. Look, it's at a quarter. And then the order flow shows. And that's what you're trying to bring in, right?
Yeah.
So if you get outside order flow,
baiting them in.
That's what we're all watching every day, right?
Golly.
I mean, think about it. That's all you're seeing is everybody's like, oh, look, everybody's got their chart, a trend line, or whatever. And like I said, if the market's we went from a billion shares a day
Yeah.
in 19 to what, 6
Yeah.
average, sometimes 8 plus,
Yeah.
you know. So when you get that kind of volume, you get that many participants, these waves of buying or selling just keep coming. We've seen those big days where you're just literally watching, okay, there's a wave and it like goes sideways,
Big movements.
another wave and another wave, and you think it's over. Maybe Thursday would have been a day like that.
Yeah, sure. It just
But
keeps going
it was
up,
only
yeah.
like 1.3, but we're
Yeah,
talking
yeah.
some of those 3%ers.
Yeah, those
It's
big
like,
days.
whoa, you
Yeah.
know, like these guys are serious. And you try to short it and try to play the reverse side because, it went up X. It just, they just keep coming.
It keeps coming.
Yeah.
Okay, so to summarize that for the individual investor, long-term bullish right now at least. You're bullish at least through Q3.
Yeah.
You don't see a recession coming. You don't see a banking crisis. You don't think the dollar or the debt ceiling matter. Basically, just invest for the next 6 months.
I think the dollar and the debt ceiling does matter, but
Sure.
the debt ceiling will be panned out. So
That'll be solved.
But the dollar is got some potential.
Oh, there's potential. And what does that mean then in the next 10, 20 years?
Oh, I don't know that.
Yeah.
I can tell you about the next 10, 20 days.
Okay.
But, you know,
so
in
dollar
the
down.
short term, the dollar's got some risk in the short term because here's what we don't know.
Yeah.
We got an election coming next year.
Sure.
There's going to be a new administration. There's going to be a new Treasury
There could
Secretary.
be the same
Hopefully,
administration.
there'll be a new Treasury Secretary.
You could have Biden again, though.
You could have.
Yeah.
Yeah. That would be really interesting. But yeah,
So how about DeSantis versus Trump?
I'm not a fan of DeSantis.
No.
I don't know what it is.
Is it like maybe too extreme with like Disney or some of the
No,
policies?
it's not that. It's just I don't know. He doesn't feel trustworthy. We were talking about trust earlier.
Yeah,
I don't. And Trump, I think for whatever he had his time, whether he comes back or not, I'm not sure.
Yeah.
Good, bad, or otherwise, don't really have an opinion. I think that he did change a lot of things when he was there from the perspective of things that he did with NATO and some of the other stuff. You know, he made some pretty decent moves there because everybody was starting to get their act together, and now it's gone. We're just talking about the dollar issue, and you know, it's what's happened now, bifurcation of, you know, pushing Russia. Imagine this. So why would you want to be a dollar holder when, you know, the U.S. could decide, oh, by the way, all the money in your central bank that you have deposited with us, we're just going to keep that.
Oh, interesting. Yeah, I mean,
Yeah,
it's probably unlikely though, eh?
Well,
Or do you mean
call Russia up and
oh,
ask
you're
them-
talking about Russia, for
Yeah,
example, or
but-
North Korea or Iran or whatever, or even China. Hey,
or anybody that gets out of line.
anybody who wants. Interesting. So
Yeah,
because of
think
the
about it.
sanction risk,
If you don't agree, then you could be at risk. So-
you're talking countries, of course.
countries, of course, you know,
so,
so-
for example, hey, Turkey, you're invading our sanctions. We're going to keep all the money that you have with us.
Yeah.
Interesting. So de-dollarize.
But
so that's
but
a real risk, the
that's
de-dollarization.
a real risk. Yeah.
Okay.
But
okay.
you know, it's probably unlikely. Just like the debt ceiling will be solved most likely.
Yeah.
And maybe there is a new pool of assets, new currency. But like I said, we were talking earlier, is that the
Goes back to
euro
trust.
took forever to.
So CBDC, don't have to worry about it for a while.
I'm a little concerned. I think that could be coming a lot faster. I think.
Oh, okay. Okay, and you don't like that?
I don't know.
What?
You know, if I look at China, I'm going to say no. I don't like it.
Right.
If
J-Pow? Janet?
Janet, I'm worried about Janet. I always call her Grandma Yellen.
Oh.
So that's kind of rude, I know, but yeah, I just don't think it's actually the incompetence that she has demonstrated on her job is shocking.
Did you like how they solved the banking crisis, or was it too slow?
No, I mean, it was obviously
worked.
what I expected.
Okay.
Open the discount
That's true.
window.
They opened the discount window.
Yeah,
Oh,
open
okay.
a discount window,
Okay.
let everybody get the money they need, fix the liquidity. That's what they're there for. That's why the discount window exists, is to fix liquidity issues.
And they solved it.
Yeah,
That's true.
and then for everybody to play this out, well, they open this and the balance sheet increased. I don't know if you noticed, the balance sheet's like collapsing back in.
Sure. Yeah.
Okay,
It's
'cause money,
already.
they don't, no one's hitting the window anymore. That's how it
it's
works.
over.
But
interesting.
like I said, I think the perspective of having watched markets for 40 years,
Yeah.
not just 20 or 10.
Yeah.
Because it's easy to think the Bernanke world exists.
Sure, and it'll come back. Yeah.
Yeah, and it's
The money printer
they're
will be
going to
back.
pivot, they're going to drop rates, that's not going to happen, I don't think. I think
Fed funds 5%.
if there was a crisis, of course,
Sure.
that.
But since you
do
don't
what
see a
you have to do.
recession, you don't see them dropping rates.
Yeah, I don't see where the recession's coming from. I did see in your stream you did.
Yes.
That whoever this guy is, like he looks around in the room and there's no recession. This place is busy. You were
Yes, yes.
talking about you were at
That
Red
was a
Robin or something.
Ross Gerber reference
Yeah.
because we love Ross. We're always talking. We say our Ross Gerber research is when we're out at a restaurant. We go, all right, time for some Ross Gerber research. It's busy. Stocks are going up tomorrow.
This goes back last year sometime when everybody was really screaming, even when we had our 2 negative quarters.
Yes.
Like, I was driving through Scottsdale, Arizona, and every parking lot was full. It didn't matter what the store was. It was like 3
no
parking
recession.
spots there,
Yeah,
right?
okay.
So, what's going on here? Why is everything full? Every restaurant you're going through is full. What's going on? And it goes back to, I think, I think the effects of the pandemic are still being felt in that people want to be alive. They want to go out and do stuff.
Have experiences and have joy now.
I mean, what it took me to get here just now is proof of that.
Thank you for that, by the way. So shout yourself out. Tell. You've been very generous with your time. Tell everybody, how can they get in touch with you? And it sounds like you have a website where people can go to learn about your platform.
Yeah, we've got a bunch of stuff. So the Kendall Report is the YouTube channel, and you have to have no spaces. That's the link there.
Kendall with an A at the end.
Yeah, Kendall. Yeah, and so then we have a Portfolio Expert website, which is where our software is, and there's no E in the expert, so it's Portfolio just with an X.
Okay.
And then we're actually working on a new site, which is just Kendall Report, which has all of that. We also have trading view indicators. We have a whole suite of indicators.
Really?
Yeah.
Trading view is amazing.
Yeah, the trading view is amazing. And
so I can get the Bob Kendall indicator on
you
trading view.
can get the WaveTech indicator. So you get something called Market Grid that predicts the daily ranges. And then you can get these, we call them PPM indicators, which are price, pressure, momentum, and they measure the momentum of those averages I mentioned, the 10, 21, 40, and 200. So we are running first, second derivatives, and there's a whole probability map. There's videos on how to use them, all that stuff. These are indicators that I've been using since they were developed in 1984.
Wow.
And we talked about earlier, we're just understanding that angle of attack, what the probabilities are. Sometimes they fail, like anything. But literally, a lot of these levels are probably, depending on the angle, there's 60, 70%. We're not going to go below that. And I say this stuff out loud.
Wow.
I say the quiet and the loud part out
good for you.
on the channel.
Okay.
And this is what drives me. So the other thing is with our software, we've got a complete view of, I think it's 15,700 symbols right now. And so we know whether we're long or short, any of those. All of our indexes are custom built. There's custom models that are in there. You just have just about, it's a complete suite. Matter of fact, we're actually packaging it with the trading view, with WaveTech. We also have what our pro side, which is called Portfolio Expert, is a platform. And it's a desktop based, so it's got a lot more power because you're not all cloud.
Yeah.
Although you would have to argue, say like we can't program our models in on TradingView. It does not have capabilities.
Oh wow.
We built a side program, even with TradeStation. We had to call other elements from TradeStation to do calculations and then feedback the 0 or 1 or whatever was the answer it was looking for. But so the software is out there, the indicators, and I cover the indicators every night. I go through all the details and show you how to use them. I did have a trading room, but I closed it down because I've got too much on my plate to spend a lot of hours sitting in trading rooms.
Fair.
It was fun.
What would you say as sort of the last question? Percent allocation to cash for somebody 25, 30 today?
I don't know. I think everybody has. I would tell you that right now we're probably 20%, 60 plus invested right now.
Okay.
And you should be that way based on, it's so individualized.
Yeah, of course.
For the stocks to make a general statement. But I think we can get, that's where we're at. Last year, like I told you, we were 60 plus in cash.
Cash, sure, yeah.
You know, we had a couple strategies that did really, really well, but you got to pick the right stocks. Like always, you still can't beat that. You still got to know that, and the whole process with the models is knowing. It's the old Kenny Rogers, know when to hold them, when to fold them.
Yeah,
so that's what the probabilities.
Gambler.
Yeah, that's what the probabilities tell you. That's what the holding. We have something we developed called the ER ratio, which is effective. So we have self-rating on every model in our system.
What about just holding the S&P?
I don't know. I don't know about just holding anything.
No comment.
So my old comment would, if this was back in the day, but it's a little different now. But if I would tell you, if it doesn't expire, I probably don't own it. So
wow.
So
okay.
I was pretty much a derivative guy.
Yeah, clearly.
So buying and holding, don't know anything about that. I'm not
trading.
Not sure. Not just trading. I mean, there's. I'm really not trying to troll Kathy, but
sure.
I mean, you just can't hold stocks forever and ever and keep saying the same thing out loud, expecting it to happen.
So S-ARC, short ARC?
No, I haven't looked at ARC. I mean, at some stage it bottoms, but
sure.
It's just, the issues there is stocks go from good to bad. Tesla can end up to be a really bad stock. It can end up to continue on. Couldn't tell you which, right? But so what you have to do, the way I look at things, you evaluate on an incremental basis and you walk it forward. So it doesn't matter what your long-term opinion is, worthless. Because it's just an opinion, right? Yeah, but what does matter is what the price is tomorrow, what it is the next day, and as you walk forward, you need to
But Warren would disagree with you.
Yeah. Warren couldn't make very much money if he didn't have government support. Just get those Goldman bonds. You want to talk about that? So anyway.
Like his preferred bonds or whatever?
Yeah.
Buffett?
But the government said, we'll guarantee them.
Yeah, interesting.
I can do that trade. How about you, right? How much money could you make if they guaranteed your trade?
There was some good preferreds he got at Bank of America, too.
He's been doing this stuff forever and ever. He's friends with every administration.
Really?
So I got to tell you a story. Well, okay, please. Here we go. Yeah. Real good story. 2020. Yeah. It's announced that Warren Buffett is selling all of his airline stocks. Remember that day?
I watched it. It was on the weekend he said that. He revealed it on Saturday at his Berkshire meeting.
Yep. So you can go to my channel.
Monday was bad.
You can go to KendallReport.com, and there is a video there, how to take advantage of Warren Buffett's mistake.
Oh!
We made 110%.
Yeah, sure. They all doubled.
Yeah. We just put them in our model, said just follow this, and 110%. And then got out of all of them, and it does what it does.
They've done nothing since then, basically. Yeah.
But but the point is, so I have a buddy, big trader in an institution in London. Yeah. It told me that the rumor was on the street that Buffett was calling up the administration saying he wanted to get bailout bonds and help finance all that, and he was told to pound sand. And so that was him showing, I'm going to get out of all my airlines.
Oh, so that was almost.
So whether that was real or not, it was. This is.
So you're saying potentially he wanted a special deal, didn't get it, so he said, "All right, then I'll dump.
I'll take my bat home and my ball. And
so I'll dump your airline stocks, and they'll suffer, and then you guys will have to bail them out more, and that's what you get for not giving Warren a good deal."
And Bob said, "They're not going to let the airlines go out of business. It's major transportation in the United States and everywhere." They're not going anywhere.
Yeah.
I mean,
do you think
once again, the simplest trade in the world, right?
Yeah.
I mean,
do you think it's possible then one of the reasons he recently dumped Taiwan Semiconductors had to do with geopolitics rather than the actual stock?
Possibly.
And the administration.
I drive by the new plant that they're building in
Arizona.
Phoenix.
Yeah.
It's a monster. It's going to take them years.
Oh, yeah. But they're getting lots of money from the government for that.
They are.
Big stimulus checks.
Yep.
I like investing where the stimulus checks are going.
There's nothing wrong with that. Seriously. I mean, I'm all for. So I always look at when you're an investor, your job is looking at cash flow. Where's the money going?
Where's the dollar?
So if money's coming out of something, where's it going? It's not always going to bonds. But there's a rotation. That's why I mentioned the small caps. The mid caps. I think there's a lot of promise in there. The patterns that are set up right now in Russell are potentially. So what we've been seeing is Nasdaq's way outperforming everything, right? But it's really bad here in the Russell,
right?
And so I run like pairs, on Russell versus that, and it looks like that's trying to bottom. And then I look at the TA and our models and stuff on Russell, and we're getting a lot of what I call secondary stocks to start to rotate in. So the stuff, this goes back to my ETF hacking comment. The stuff off the radar is going to be where the money is going to get made in the next round. And I don't think necessarily there's going to be a new ATH, new all-time high or anything like that.
No, not anytime
There might be, but that's not my forecast. But
so calls,
these
all in YOLO calls, entire portfolio, 90-day call options on Russell 2000.
Yeah, there you go. Why not? We actually technically do not have a buy signal in the Russell at the moment. But
you're waiting for it.
Yeah, but the patterns,
it's still
that's
bottoming.
what I'm saying, the patterns they're setting up are suggesting that this could be where the money flows. Because a couple of things, we're just talking about this. What do you do when you're investing? You look for something cheap.
Yeah, sure.
You're not going to buy, the techies because they've done so good.
They've already done very well. You may as well diversify down.
Plus, where are you going to go with that? Maybe it goes. Maybe it goes 30. That doesn't mean it can't.
Yeah.
But I'm saying that what you want to start looking at is some of the mid and the Russell stocks could be. There's some gems in there.
So go digging.
Yeah,
I like
do
it.
that.
I'm going to go gold mining.
Do some fundamental analysis.
I like that.
Find whatever kind of financial ratios you like. Just go and you dig through that stuff.
Yeah.
We have in our screens we have some metrics that we look for. Right. Everybody has a little.
Sure. Everybody's got something.
Metrics.
Yeah.
That,
what's your favorite?
I'd have to bring up. There's like
that's
20
fine. Yeah, you got a bunch of them. You got so many.
Yeah. If you saw, I'll show you my spreadsheet.
And when you're back from Singapore, I'll come raid your office.
There you go.
Go check it all out.
Yeah, no, it'd be fun.
Thank you.
But yeah, you're welcome.
This has been amazing. So thank you so much. We're going to link everything down below that you mentioned.
Awesome.
And we'll have to do another video when I check out all your screens.
Okay, awesome.
Thank you so much.
You're welcome.
Pleasure.
Thank you. My pleasure.